In this lesson, we will cover strategies for tax due diligence. The topics for this lesson are as follows. 1. Purpose and scope of tax due diligence. 2. TDD checklist. 3. Working with advisors. 4. Tax risk profiling and mitigation. 5. Transaction structures in M&A TDD. Tax due diligence, TDD, in M&A assesses potential tax liabilities and benefits that can significantly impact the transaction's financial outcomes. It involves a thorough analysis of the target company's tax compliance, obligations, and strategies, ensuring that buyers are well informed about any tax risks or opportunities associated with the acquisition. Key areas of focus in tax due diligence. Corporate tax compliance and liabilities. Examine the target's corporate tax returns and computations for accuracy and compliance. Assess the implications of previous reorganizations or transactions for hidden tax risks or future costs. Analyze any share-based payment schemes for proper tax treatment and potential exposures. Employment taxes. Examine the target company's compliance with employment tax regulations. Investigate adherence to payroll tax requirements, ensuring compliance with local or international taxation laws in various jurisdictions. Value-added tax, VAT. Verify VAT or equivalent sales tax compliance through transaction reviews and exemption assessments. Evaluate the target's application of VAT schemes and options to mitigate risks of tax assessments. Transfer pricing and thin capitalization. Review transfer pricing policies and documentation for compliance with local and international standards. Assess the risk of thin capitalization, where assets are funded with high levels of debt and little equity, leading to significant tax exposure. TDD process may include renegotiating the price, seeking indemnities or warranties, or excluding specific disclosures to protect the buyer from unforeseen tax liabilities. Equally important is the planning for tax issues that may arise due to the transaction, including understanding how the deal will be structured for tax efficiency. Strategizing for post-acquisition tax efficiency. A key aspect of tax due diligence is not just identifying current tax liabilities, but also planning for post-completion tax efficiency. This involves integrating the acquisition into the buyer's tax structure in the most tax-efficient manner, aligning with commercial objectives. Attention to detail is required for future tax planning, how the acquisition can be structured to minimize future tax costs. This may involve utilizing tax losses, understanding past M&A transactions, and assessing potential tax liabilities. Employee benefit reporting and stamp duties. Evaluating employee benefit schemes and understanding stamp, transfer, and capital duties related to the acquisition. Tax due diligence is inherently interdisciplinary, overlapping with legal and financial domains. Therefore, tax advisors must work closely with financial and legal advisors. This collaboration ensures comprehensive information sharing, avoiding any oversight or duplication of efforts. TDD.